Here we are. So we're ready to start. Good morning and welcome to this PLSA webinar on climate solutions for pension scheme trustees, sponsored by MSCI. My name is Edward Bogira and I'm responsible for member communications and content at the PLSA. Today we are joined by Veronique Menou, MSCI's head of ESG indexes for EMEA, David Farrar, senior policy manager for investment and governance at the DWP, and Andrew Warwick-Thompson, chair of the Scottish Widows Master Trust. Thank you all for joining us. Now, anyone familiar with the PLSA's recent policy work, our annual conference a fortnight ago, and even our most recent webinar yesterday will know that climate change is a huge issue for our planet and for investors. This session marks the official launch of our Climate Indexes Made Simple guide, sponsored and authored by MSCI and published at the beginning of August. It's a great introduction to the subject and it's already been downloaded 350 times in the last 2 months, which is good going. And it's one of a number of resources on ESG and climate change available from your PLSA. I will post a link to the guide and some other things in the chat box during the session. So this morning, we're going to explore how pension funds can take account of climate change as both a risk and as an opportunity. And our 3 speakers will take you through that journey. So David is going to set the regulatory context for investment and climate change and how it's evolving. Veronique will cover some of the issues raised in the Made Simple guide, including setting investment objectives and of course solutions including climate indexes. And finally, Andrew is going to look at some practical considerations for implementing climate solutions for schemes. Together, they'll talk for about 35 minutes, so there's going to be plenty of time for questions at the end. And now, before I hand over to David, we're going to do 3 quick polls. These will pop up on your screen and you simply click on your answer. So let's launch the first poll. Have you made a commitment within your statement of investment principles to be Paris aligned or net zero? And your options are yes, we are currently considering, or no. It seems, well, most people are either currently considering or no. Well, I hope David will be able to set out your responsibilities there and why you should be looking at this. Let's move on to our next poll. I just have to click around a little bit here. So here we are. Have you or your advisor evaluated the risks your scheme faces from climate change? And your options are yes, we have evaluated the risk. No, we are currently in the process of doing so. Why would climate change affect the assets in my portfolio? Or no. Okay, I think the numbers have stabilized there. So, well, the majority there are currently in the process of doing so, which is good. You've come to the right place because our speakers will be covering how you can do this with plenty of practical tips. Apologies, I just lost the poll. Here we are, poll number 3. Do you use a climate index now within your investment strategy? And your options there are yes, we are using climate indexes already. No, we plan to in 2 years. No, we plan to in 5 years, or none of the above. Okay, here we are. Here are the results. So a few are using them already. Healthy number planning to in 2 years, but just over 50% not planning to use them at all at this point. So, well, Veronique will certainly explain how they could work for you. But before then, it's over to David to set the scene. So, David, we're all yours.
Thanks, Edward. Hi, can I move to the next slide? Please. Sorry, and the one after that. Thanks for inviting me. I'm going to speak for a little under 10 minutes this morning. Some of this will be familiar to people who've been to other events run by other organisations, so apologies for that. But hopefully, some of the other material that you hear this morning will be new and useful to you. I'm going to start by setting out a bit of an overview on DVP's work on climate change and ESG to date, and I'll be summarising the reaction to that. Then I'm going to home in more specifically on climate change, which is, after all, the theme of this morning, in an effort to explain the motivation for our current round of work on the Pension Schemes Bill. That's the Taking Action on Climate Change consultation. And as part of that, I'm going to be offering a quick summary of the proposals there and our next steps to give you an idea of the direction of travel. Finally, sorry, that's going to be all I'll cover, and then I will hand over to Veronique. I'm just going to move on to the next slide. So here I'm presenting a timeline of government's work to date on the kind of ESG more broadly and climate change in particular, going back into the dim and distant past. You'll be very pleased to hear that I'm not going to talk through all of this, but I would just make a couple of points. I guess the first reflection is that in some ways this timeline might feel a bit like one of those life of the earth condensed into one day sort of examples where ESG and climate change only emerge at 10 p.m. alongside the mammals in the history of the world, and the Task Force on Climate Related Financial Disclosures, which is a recommended framework for organisations, including pension schemes, to disclose their climate risk, appears somewhere around 2 minutes to midnight alongside the Neanderthals. So I recognise fully that there's been a lot of action in recent years, and some of that has been challenging. But I'd also turn that around and say that the seeds of this sort of necessary change have been coming quite a long time. DWP's previous legislation, the extent, if at all, to which environmental, social or ethical considerations were being taken into account was around 19 years before it was replaced, right over there on the left-hand side of this timeline. But the K review, as long as 8 years ago, identified fairly deep-set confusion amongst trustees about their fiduciary duties on this space. And the Law Commission 6 years ago made recommendations for change too. So from another perspective, while we might say this has been a pretty condensed and rapid gallop in recent years, lots of these changes are long overdue. We've lost valuable time in addressing climate change risk by allowing a view to take hold that considerations about climate change or other environmental concerns can only be ethical, or wrongly the fact that because some members care about them, the fact that they're ethical concerns to some members means that trustees can't act on them as financially material considerations. That confusion, which does still seem to exist in pockets of the industry but is quite wrong, suggests that there is still work to do in this space. I'm just going to move to the next slide. What I'm doing here is just summarising data from a few sources. Research on the ESG legislation, which came into force last year amongst trustees by Hyman Sackers, the pensions regulator. And on the following slide, some further DVP research as commissioned by our minister in his letter to the top 50 schemes last year. In summary, I think what we're seeing from the SIP regulations, which came into force back in October, are that broad support for the legislation amongst advised schemes and a general state of readiness, but not necessarily a huge amount of action, and that might be sort of backed up by the reports we just heard about. The polls we just heard about. Other firms found SIP updates were largely for compliance purposes, and relatively few seem to be making material changes. You might conclude from this that perhaps everyone was doing the right thing anyway, and we've all now collectively ironed over a confusion, a wrinkle in legislation, adjusted our SIPs, and got back to doing what we were doing, which was pricing in climate risk. But I don't think that's really stands up to scrutiny as an argument. And to understand why, let's look at the results of TPR's research, which is the only sample here that's representative of the pension scheme universe, in this case of DC pension schemes. This research was carried out in advance of the October 2019 legislation coming into force, but the argument that trustees were not required to manage climate change, or that climate change wasn't relevant to their scheme, does fly in the face of the conclusions from the Law Commission that material risks need to be factored in whatever their source is. So this suggests that schemes either don't understand the nature of trust law, that they should be considering all risks and opportunities wherever they come from, or don't understand that climate change probably is a material risk for them. And that view wasn't limited to the smaller schemes either. Even a majority of schemes with 1,000 or more members said they didn't take account of climate change. If we move to the next slide, which covers the responses to the ministerial letters, we see a more positive response coming here. This is probably because these went to the largest 40 defined benefit schemes and the largest 10 defined contribution schemes. We found much higher levels of action in larger schemes, 70% going above the minimum, so well above the kind of compliance minima that we saw on the previous slide. Nevertheless, we did find low take-up of disclosure in line with the TCFD recommendations, where at that time there were no legislative requirements. That's really informed our approach to climate risk governance and disclosure, which I'll speak about in a moment. We've chosen to legislate for the next phase rather than encourage, because the low take-up of disclosures in line with TCFD suggests that voluntary action won't necessarily get us there. But we are adopting a phased approach, with the larger schemes with the greatest resources moving first and setting a standard for smaller schemes to follow in due course. I'll move to the next slide, and as threatened here, I'm going to home in on climate change in particular. So starting with this idea of this kind of systematic realignment of the economy, these shows the models from one consultant. Sometimes the changes seem very far off to people, that the risks won't land for many more years, and therefore this isn't something we need to be worrying about. But this model shows that changes in sectoral variations in a world where action is taken to limit temperature rises to 2 degrees can actually be quite dramatic. These are the valuations that we're talking about here. So valuations of coal stocks could be down a further 59% or on their already reduced level in 2019 through to 2030. Oil and gas could fall 42% in valuations between 2019 and 2030. Renewables could be up 106%, electric utilities down similar amount to oil and gas, infrastructure up by broadly similar amount, and sustainable infrastructure up by significantly more. So these changes can be arriving in the relatively short term and can be affecting even assets that DB schemes think DB schemes who would consider themselves largely de-risked are investing in, not forgetting the effect on their sponsors too. These changes are dramatic. Why are these changes so significant? They're dramatic because markets are currently pricing in a very limited transition, consistent with an increase of 3 to 4 degrees Celsius. That might well be the outcome. This is extremely challenging that would be extremely challenging for all of us if that is the outcome. But we should stop and think about what this kind of pricing in exercise actually means. And pricing is ultimately, a cash-weighted average of guesses by all of the market participants, based on the best information which is available to them at that time. Those guesses might well turn out to be good guesses. Pension scheme trustees, as with other market participants, are free to make those assumptions and invest accordingly. But they could well turn out to be wrong. The US might sign up to the Paris Agreement. Events of next week might determine the direction of travel there. International cooperation might emerge in a more wholehearted way than it has today. Governments might meet the goal which is set out in the Paris Agreement. That in itself is a wholly plausible outcome, and it would have a dramatic effect on your valuations if your portfolio was optimized for 3 to 4 degree rises. Even if your assessment or your overall belief is that this won't happen, wouldn't you want to still know what would happen if your belief turns out to be wrong? It feels like all of these things need examining. So that's what our legislation is really aiming to make schemes do, not to fix climate change for the government. We don't have any intention of mandating schemes to set net zero targets or to be Paris aligned. This is entirely pension schemes' decision, but we want pension schemes to consider those alternatives and manage the risks accordingly. So in this case, we think a legislative framework is necessary because climate risk has, in the words of our minister, the ability to wipe out swathes of the economy far more effectively than the natural or even the exceptional variation in interest rates or exchange rates, which might preoccupy us on a day-to-day basis. If I move to the next slide. This brings us to the proposals, which I'll very quickly cover in this and the following slide. I won't say much because the consultation is now closed. We're reviewing the responses and adjusting our approach accordingly. Thanks to anybody on the call who has responded. If we move to the next slide now, these are the proposals in overview. And I'll just touch on a couple of these. So what we're proposing is that schemes in scope of doing the climate governance from the 1st of October 2021 will be those with 5 billion or more in net assets and authorised master trusts. They'd be needing to report by the end of 2022, and then 1 year later that 5 billion threshold would be dropped to 1 billion. And in 2024, we take stock and review whether to extend to smaller pension schemes. We're requiring schemes to disclose the results and to tell members where they can find their TCFD report, but this is not primarily about disclosure. Disclosure is the end stage of showing your workings. It's not just about members either. Trustees can learn from the work of other comparable schemes in how they do TCFD, and so the opportunity to review other schemes' public disclosures is useful for trustees too. We've proposed at least 2 scenarios, one of which is 2 degrees or lower, and we're proposing to permit qualitative scenarios for now, rather than insist on hard numbers, which are going to be necessarily imperfect and inaccurate right from the start. We're also prescribing at least 2 metrics, at least one of which is greenhouse gas emission based, and both scenario analysis and metrics and targets are duties which would apply as far as trustees are able, in recognition of the dependence on a data flow from investee firms and via asset managers. And I'm just going to wrap up with this final slide. This is our next steps. This is the next opportunity that trustees and other stakeholders will have to feed into departments' thinking on this will be with the consultation on regulations and statutory guidance that very much sets out the how of TCFD reporting, which is set for January 2021, with regulations to be laid probably in June, debated in July, and coming into force for October 2021. This might look like a fairly dramatic timescale, but I'd just say 2 things to clarify that. First of all, obviously, remember this is only applying to around 100 schemes in the first phase. That draft statutory guidance will be out in January for trustees to start to get ready, and the earliest that anyone will need to be actually reporting on what they've done is May 2022, with many schemes getting considerably longer, even if they're in the first wave. And the second consideration is obviously that we don't have much time. We do need to act fast, and we can't wait for all of the data to be perfect. Lots of good data is already out there that pension scheme trustees can start to get to grips with, and more is emerging through duties on asset managers and investee firms. I'm going to leave it there, and I think hand on to Veronique.
Thank you, David. Good morning, everyone. So thank you also for inviting me to participate in this panel discussion. David, you made a very insightful, interesting presentation, which I think set the scene really well and also explained the rationale as to why investors should consider climate into the investment process. What I would like to focus on today is kind of provide a highlight of what are those key steps for pension schemes or investors, more institutional investors more broadly, to integrate climate into their investment process, and also highlight some of the potential solutions and tools that are available. But let me first start by saying that at MSCI, we strongly believe that climate change is going to change increasingly the risk and return profile of companies as well as industry. And whether we're talking about transition risk or physical risk, and we believe that it is also going to significantly increase the risk in investors' portfolio. Can you move to the next slide, please? So with that in mind, our mission at MSCI, and in particular from an ESG and climate standpoint, is really to provide tools for investors to build better portfolio to then create a better world. And so I won't go into all the details of our offering, but just wanted to highlight that we offer solutions stemming from data, because obviously it all goes back to what kind of data is available, especially from a climate change perspective. We now have better data, not only backward looking, but also forward looking. Second, we have indices, and especially through the guide that's We also then work with PLSA that was published in August. I think you can also better understand what kind of indices are out there. And we actually also recently launched our Climate Paris Aligned Index, which is really an index that aims at addressing all key dimensions from climate change. Then obviously, and I think David just mentioned that around reporting. Reporting is very important. TCFD is very important. It is already required for UNPRI signatories. And this is also the type of offering we have at MSCI. So we provide tools for investor analytical tools, and in particular, managed service for TCFD reporting. And last but not least, I think what is also very important around climate and climate solution is the expertise. This is, we're still in the early stages in ESG and climate investing. Models, more models are needed, more data are needed, more analytical tools are needed. So I think it's important to have strong research and expertise. And at MSCI, we acquired a Carbon Delta, which is an environmental fintech last year, and which really allow us now to have a very strong climate expertise and a very strong climate, what we call our climate risk center. Can you move to the next slide, please? But what is very key when we see investors start their climate journey is first to really identify the objective. What is it that you're trying to solve for? And so we have the opportunity to talk to institutional investors globally. And what we've noticed is kind of 3 steps in this climate journey. And that's very important to, as a first step before looking at tools and solutions to really understand what you're trying to achieve. So this very first step is when investors want first to mitigate their exposure to risks associated with assets trending. And in particular, we see increasingly also investors willing to reduce their exposure to those companies that have high carbon emissions or owning fossil fuel reserves. But it's not only about the risk, right? It is also about capturing some opportunities. So that's kind of a second step, or potential second step, is we see investors willing to shift capital from brown to green and not only reduce their risk, but also try to capture the upside from the transition to a low carbon economy. And then the potential third step is when really investors are willing to address everything, all key dimensions from climate, not only transition risk, but also physical risk, capture the opportunity, as well as have an impact through their investment and align their investment with a 1.5 degree scenario. Can you move to the next slide, please? So once those objectives are met, then investors have 2 choices. They can either adopt an active strategy or a passive one. But for both strategies, they need data, right? So that is very important. And I think we have made very great progress over the years around data. And we now have, from a climate standpoint, an extensive set of data that helps them build better solutions, whether it is for an index, whether it is for an active fund, whether it is for a reporting at a portfolio level. It is obviously very key to have this data. So these data, and you can see some examples of this slide on the slides, that can be grouped into 2 categories. One is backward-looking information, but it's still very useful, even if it's looking at past data. And here we would consider obviously carbon emission, direct, indirect, or the so-called Scope 1, Scope 2, and Scope 3, fossil fuel reserves, green revenue, so companies generating revenue from clean technology. So those are kind of the example of some indicators that are important. But then increasingly also we see investors interested in forward-looking data. And that's where I think we've made very great progress recently with now company reduction targets, even though, not all companies would do that. We certainly need progress, but I think that's an indicator that is very relevant. We also now, have patents. So in order to identify the leaders of tomorrow, those companies that will develop green technology, and obviously scenario analysis. So at MSCI, we have our climate VAR model, which is a valuation assessment of the risk and opportunity for companies from a climate standpoint. Can you move to the next slide, please? So these data can obviously then feed into, as I mentioned, either active or passive. But I think I just wanted to highlight, some of the passive or index solutions that are available on the market. And I group them under the three objectives that I mentioned at the beginning of this presentation. So, for example, when investors try to reduce their exposure to asset trending, they can adopt a low carbon strategy. What it is that, or low carbon index. What it is an index that will aim at reducing the carbon footprint, as well as the exposure to potential emissions coming from reserves, but not necessarily deviating too much from the traditional benchmark, which means having a tracking error that would be minimal compared to the parent benchmark. When they want to then also, capture the opportunity, they can move to the climate change or climate transition type of indices. What they aim at doing is really being broad and diversified, but really shift capital from brown to green. So not only you're reducing risk, but you also are capturing opportunities associated with the transition to a low carbon economy. And the potential third step is really for investors looking to have, a holistic approach towards climate change, address all key dimensions, transition risk, physical risk, capture, the opportunity, as well as have an alignment with a 1.5 degree scenario. And that's typically, the new Paris Aligned Index that have been launched recently. And in particular, at MSCI, we launched our Paris Aligned Index on Monday. Can you move to the next slide, please? So now that we've seen, what kind of index solution exists, I think it's also important to know how we can use those index solutions. So indices are very well known by investors and commonly used by investors because they are rules-based, because they are transparent, methodology are publicly available, and also because they can be used as part of a cost-effective solution to implement a climate strategy. And we've identified four main use cases for indices. The first one is asset allocation. So it's used increasingly by asset owners and institutional investors to guide their strategic asset allocation. And we see increasingly investors and asset owners using a switching benchmark, and instead of using a market cap benchmark, adopt ESG or climate benchmark for their strategic asset allocation decisions. Second use case is financial instruments. So indices and climate indices in particular can be used as an underlying for an ETF or a mutual fund. Third aspect is they can also be used by active manager as a performance benchmark. So we see now also increasingly in Europe and also globally as active manager willing to use to benchmark their ESG or climate fund to use a climate benchmark in order to highlight their stock picking capability, but also their commitment towards climate change. And emerging, the last use case, which is kind of an interesting one and an emerging one, is that indices are also increasingly used as complementary approach to engagement. So here we're not talking about obviously direct engagement with company, but more like indirect engagement on a broad scale. Because as an investor, when you invest into an index, you convey the message that you're willing companies to integrate, the climate or potentially an ESG signal, right? And because indices are rule-based and transparent, companies know what they have to do in order to be eligible for a climate index, for example. So with that, I just wanted to conclude by saying that, we strongly believe that climate change is affecting, risk and the risk profile of companies and of investors' portfolio. And we think that we are now at a stage where we have very strong solution to help investors, reduce their exposure and manage their medium to long-term risk. Thank you.
Thank you, Vero. That was very interesting. And now we know PLSA members, they're always keen to hear some practical insights. So it's time for Andrew to share his experience from Scottish Widows.
Good morning. It's a pleasure to be with you this morning. Thank you very much indeed, Veronique, and for David for some excellent presentations. As has just been said in the introduction, my role on this panel is to give you some practical insight into how the Scottish Widows Master Trust has gone about incorporating ESG principles into our investment strategy. This is a work in progress, but I believe that the governance framework we have in place now is sufficiently robust to evolve in the future. I'll also give a couple of examples to illustrate how we're modifying our investment approach at the default lifestyle strategy and self-select fund level to bring ESG investment to our members. Could I have the first slide, please? So this diagram gives a high-level picture of the investment governance framework the trustees have in place generally, and with a specific focus on how we are addressing ESG. Our general approach applies across all of our investment portfolios, but if I talk about that and all its aspects, we'll be here all afternoon. So I am going to focus my comments only on the ESG. Our approach to investing is set out in our Statement of Investment Principles, which you can download from our website if you wish. First, I think it's worth stepping back and asking why we have implemented ESG within the Scottish Widows Master Trust. Yes, there is indeed a legislative and regulatory aspect to this, as is shown in this diagram. But more importantly, the trustees believe that ESG, and climate change specifically, is more than just a tick box exercise. As we've set out clearly in our SIP, we expect investment strategies which incorporate ESG factors to benefit our members financially. We acknowledge that climate change is a financially material consideration, and that responsible stewardship should have a carbon focus. Now, this isn't simply pandering to populist Attenborough hugging. It's a hard-headed financial analysis. I believe that if we cut through the noise of COVID-19 pandemic and the Brexit brouhaha, the most significant financial risk to our members' retirement outcomes in the long term is climate change. In fact, even in the shorter term, the financial risks associated with managing our members through the transition from a carbon-based economy to a low or carbon-neutral economy is huge. So as trustees, we must be alive to making the most of the investment opportunities transition presents and mitigate the climate risks posed to the longer-term member outcomes. In fact, I believe not to take steps now would be a dereliction of our duties, irrespective of regulatory compliance. The trustees of the Scottish Widows Master Trust rest our approach to ESG on three key governance documents: our SIP and two supplementary policies which cover what we mean by ESG and how we will act as stewards of the scheme assets. Specifically, our stewardship policy sets out how we will ensure that our ESG principles are reflected in the way our assets are managed and our voting rights exercised. Now, writing all this down is one thing, implementing it is another, and the key to that is set out in our investment governance reporting framework. This covers, at current count, 22 areas of focus on which we expect Scottish widows to report to us in their regular trustee investment governance reports. This is no mean feat, and the level of granularity that we now require on the adherence of Scottish widows to our requirements for due diligence on managers and how those managers themselves are complying with our policies and voting our shares is considerable. However, it's essential to go to this level of detail if we're to be certain that our policies are adhered to. We don't want any boo-hoos in our portfolio. I see this as a circular process and anticipate that we will regularly update our SIP and ESG stewardship policies as the level of sophistication of ESG products evolves over the coming years, not to mention how we will flex our investment strategy to incorporate social impact investing. How we manage this process is set out amongst other things in our chair statement, so ensure that we are open and transparent to our members and the regulator and any other interested party and how we are managing the scheme. Could we have the next slide, please? Stewardship, as I've just explained, is how we walk the talk rather than just talk the talk in our SIP. The way that we do this as trustees of the Scottish Widows Master Trust is by influencing Scottish widows. This is simply a practical recognition that we're in an insured scheme and that we access the market through a policy of insurance and, through that, external fund managers appointed by Scottish widows. The scheme has no direct manager appointments. Our approach to stewardship is engagement, that is, seeking to influence the managers through which we invest or the boards of the companies in which we invest to do the right thing. However, we recognise that there needs to be a carrot and a stick, so we're developing policies on exclusions, which will screen out certain types of investment to ensure that we never own them, and a disinvestment policy, which will cover the eventuality that engagement has failed and that we must vote with our feet. The current focus of our engagement activity is on climate change and diversity. This is reflected in the structure of the investment governance reporting framework that we have in place currently. Finally, we must acknowledge that there are limitations on our influence. We invest predominantly through passive pooled funds, so whilst combined with the might of the Scottish Widows and Lloyds Banking Group, we have considerable clout, there are other substantial institutional asset owners invested in these funds too, and our views will not be the only ones that the managers and boards have to listen to. In these circumstances, clubbing together with other asset owners to gain influence is necessary. Could we have the next slide, please? I'll now give two brief examples of how the trustees have begun to address ESG at the fund level. First, the trustees have decided to shift around 10% of our global equity portfolio initially, which is a constituent part of our default lifestyle strategy, into the BlackRock Climate Transition World Equity Fund. This meets the three objectives set out on the left-hand side of these slides. These are to decrease carbon emissions, reduce water consumption, and improve waste management. The targets for these objectives, which is what the trustees will be monitoring closely, are set out on the right-hand side of the slide. This is also a good example of the combined clout of Scottish Widows and the Lloyds Banking Group. This fund has been jointly designed with BlackRock to meet our ESG objectives, and we're founder investors in the fund, although the fund is now open to other asset owners. I should mention too, given present company, that the fund is based upon a tilted version of an MSCI equity index. Could we have the next slide, please? Second, and finally, the trustees are considering how to address impact investing. This is early days for us. We believe that we should strive to avoid any investment strategy which causes social harm as part of our ESG policy. However, identifying opportunities that will have a positive social impact and offer a reasonable rate of return is trickier, not least because the concept of positive social impact can be politically loaded. For example, I don't believe that as trustees we should accept a transfer of responsibility for delivering a government's social policies. That said, we expect to add a positive impact fund to our self-select range later this year. This will join ethical and Sharia funds in our self-select fund lineup. How long it will be before we add impact investing into our default strategy will be driven as much as anything else on the speed of good products being developed in this sector. Thank you for listening. I look forward to taking your questions later.
Okay, thank you, Andrew, and thanks to all three of you for your thoughts. We have approximately 19 minutes for Q&A. Good to see the disclaimer there. Approximately 19 minutes for Q&A. We have a few in the chat box. I think, if I may, I might just ask one of David myself to begin with. David, as you put so beautifully with reference to the evolution of humanity, regulatory activity in this area has really been accelerating over the past 12 months or so. But in your opinion, do the new requirements of trustees go far enough, or could we and should we see more in the future?
So I think I'll answer that in two ways. I think in relation to the larger pension schemes, the proposals that are now on the table that we consulted on in August do go largely far enough, perhaps too far, based on some of the responses we've had from some respondents. But we think that TCFD is rapidly gaining currency as the standard mechanism for climate change disclosure, and we do want to put the kind of governance duties behind that. I think as long as we do that job right and trustees engage constructively with that, then I think that will be sufficient. I think in relation to the kind of 95% of schemes who aren't in scope of those requirements because their assets are below 1 billion and they're not authorised master trusts or authorised collective money purchase schemes, then I think we do have a bit more of a challenge. I think compliance, as revealed by reports such as UK Sustainable Investment and Finance Association earlier this year in their changing course report, has shown quite a lot of box ticking compliance, quite a lot of minimum viable disclosure, sometimes perhaps I don't know whether driven by consulting community or driven by lack of appetite on the part of trustees. But I think we do need to move beyond the kind of form of words that says we acknowledge ESG and climate change may be financially material risks, but we leave everything to our fund managers. I don't think that's a full recognition of trustees' fiduciary duty, and trustees have got more of a role to play in managing climate risk for their members than just delegating everything.
Okay, thank you. So I guess following on from that, there's a question for the panel, which is, do you think regulations and developments have adequately tackled short-termism, or whether some of the requirements being implemented at the moment, such as GHG metrics, may inadvertently drive short-term measurement? David?
I think that's a risk. That's something that we want to guard against. I saw there was another comment that was put in there about a quarterly greenhouse gas emission collection of data. I think it's fair to say that was not a terribly popular proposal in our consultation, and that's something that we will be closely reviewing because of the short-termism and perhaps the new work that might be involved in doing that. I just think there's always going to be a tension. You can have a backward-looking measure that is correct at the point of view, but doesn't tell you about the companies you're investing in and the progress that they're making towards, a low-carbon transition. Or you can have a forward-looking measure which should work better, but is still reliant on the companies in whom you invest following through on commitments. Most of the commitments which large companies have made in relation to reducing Scope 1 or 2 or potentially even Scope 3 emissions over timescales. Over certain timescales are often very long range. They don't have intermediate targets. They're not necessarily matched by capital expenditure, and so that means that you have to take those with a pinch of salt too. I think what we would advocate is a combination of backward-looking and forward-looking metrics, and I think that's likely going to be where we land in our final TCFD proposals.
I don't know if Andrew, you have anything to add on that, or Veronique? You don't have to. Okay, in which case I'll move on. So Veronique, there was an interesting question from Mark Yates about standardization. Is the lack of standardized data reporting in this area a barrier to progress, do you think?
Yes, that's a good question about data quality and standardizations around data. So just to be clear, I think the data is good compared to what we have. Is it perfect? No. Does it still allow us to use it in investment decision and financial product? Yes. Why? Because I think we've made first of all, there's been progress, right, in terms of disclosure. If we look at the various data points, we can still see that companies and insurers have made great progress. But second, I think, we are at a stage where we also know how to model and estimate the data. So, for example, on Scope 1, Scope 2, Scope 3, they are now good estimation models. They may not be perfect because they are estimations. But still, I think it's definitely useful and can provide insightful information for investors. So the other thing which is also very important is that, for example, in our climate or ESG analysis, we're not only using company disclosed information. And just to give you an example, in our ESG rating, it's pretty much half of the data source that we use for our rating that is coming from third-party data sources, right? So companies is definitely, a source of information for ESG or climate data provider, but it's not the only one. There are other, data sources and alternative data sources that can be used, and that can also help us then derive good signal. Now, in terms of the standardization, I think there's lots of work being done at the moment, like through various initiatives, regulatory one or market-driven, to achieve standardization. And at MSCI, we clearly believe that there is a need for standardization. But once again, it's not because we don't necessarily have it yet that we can't already consider ESG and climate issues in investment.
So thank you, Veronique. I think we'll have a question for Andrew now, although Veronique, I think you'll be able to add to this. So Martin de Vrij, I hope I pronounced that correctly, says it's common to see first steps in this area taken in the equity space, but have you started looking outside of that, perhaps at corporate bond strategies?
Have we done anything on that? No, not yet, but we are doing it, and we will move into that area next. And on the TCFD point, we've already commenced our audit, so we should be receiving the results of that early next year. I should add that that's not just in relation to the master trust; it's in relation to all of the assets in the Lloyds Banking Group portfolio. So I anticipate that our approach to this has started with equities because it's now relatively easy to do that. But we will want to look at our bond holdings as well. And our SIP makes it clear that we want to implement ESG approaches across our entire portfolio, not just to one asset class. So that will develop, I think, quite quickly now.
Okay, thank you. Veronique, do you have any views on how the climate affects the entire portfolio?
Sure. So that's definitely a key trend we are seeing recently around ESG integration, right? So I think it started with equity, but then now we see a lot of interest on the fixed income side and other type of asset classes like real estate and private assets. From a fixed income perspective, like at MSCI, we have the similar assessment for corporate issuers and equity. And from an index perspective, we recently launched our climate change index on the fixed income side. And we also have, with our partnership with Bloomberg Barclays, we have a green bond index. But definitely, this is interesting to see that increasingly we get asked also when we have index discussion by investors. They're really interested to have a similar methodology both on the equity and on the fixed income side. So, for example, with some of our climate indices, we can offer that, and that's definitely something that is very well received by the market.
Thank you. Couple of questions about engagement now for Andrew, I think. So Andrew, Robbie Martin is interested in your engagement and stewardship plans and possibly disinvesting if companies don't change. Can you expand a bit on the hurdles you have in place for compliance and how much time you allow for change and how you measure or judge progress in that area?
It's important to say that we're working on the disinvestment. So I think that the first thing that is likely to happen is that we will agree an exclusion policy. That's already something that's been discussed at the trustee board, and we're likely to implement before the end of the year. In terms of disinvestment, that particular policy is in very early stages at the moment, so we haven't set hurdles at this point in time, but I expect that we would have done that early next year. I think it's important to stress, of course, that all of our engagement is through Scottish Widows, so that the trustees are very keen that we set our policies in a way that Scottish Widows is able to implement. There's no point doing it otherwise. but they are also very keen in this area. So I think working together with them, we will come up, as I say, with an exclusions policy probably by the end of this year, and then by a disinvestment policy like early next. So we'll get there within the next 6 months at the latest.
Okay, thank you. And what about member engagement? So all our events recently, we keep hearing that this is the area that is really going to excite pension scheme members and get them engaged on in their schemes and what their schemes are doing. How can trustees gauge the views of members on ESG issues, and is there a danger that perhaps a small minority who are more vocal or have more conviction in their views shape the conversation? And can member-nominated trustees help with that, asks our anonymous questioner.
Okay, I'm happy to answer that. We don't have member-nominated trustees on Master Trust Board, and we have no plans to ask to appoint member-nominated trustees. Our engagement is through membership forums and indeed through employer forums, and we also rely on surveys that we do across the membership. What I can say is that the shortly to be announced addition of an impact, social impact fund into the self-select strategy is based on member feedback. There are members who would like to see that. But I think as the implication of what you just said is correct as well, which is it's a relatively small number of members. So I think that with the view that we have at the moment, based on our current membership, is that we want to be able to be, our members want us to be focused on ESG, particularly on climate change, and the vast majority of our members invest through the default lifestyle strategy. So that's where most of the change is likely to come in the short term. And for impact investing in the short term, that will be a self-select option for the reasons that I stated, really. I think that we're quite early on in the development of social impact funds that are accessible, which were appropriate for us to put into our lifestyle strategy. But it will happen. I think we're probably, with social impact, I think we're probably, where we are now is probably where we were with ESG 5 years ago. I think there are insufficient products in the market at the moment. If there's sufficient demand from our membership, we will work with Scottish Widows to develop a product, as we have done with the transition risk. With BlackRock, we'll work with another provider, perhaps, to put in place a suitable fund. But we do listen to what the members say, but we're not driven by it. Our risk register is what drives our product enhancements.
Mm-hmm. So interesting. You feel we haven't moved in 5 years, and perhaps products are behind regulatory progress on this. I don't know if Veronique or David, you have anything to say about that?
Thanks, Edward. I don't. I probably don't too much on the availability of products in relation to impact. Obviously, we're not legislating for pension schemes to consider impact. We think there are products out there that allow pension schemes to act on climate risk and to manage the climate risk. Such as the ones that Veronique has been, talking about. What products based on the indices that Veronique has been speaking about. On the members' views point, I totally accept the questioner's point that there is a risk that you end up with a very concentrated and unrepresentative, range of respondents to questioners. But the government's been absolutely clear in following the Law Commission's advice is that there is no legal duty on pension scheme trustees to take account or to act on members' views. It should be driven from the risk register, as Andrew says. It's an option, and we ask trustees to set out how, if at all, all, they take account of members' views. But the if at all is absolutely crucial. We're not setting an expectation. And clearly the Law Commission are quite clear in their guidance to pension scheme trustees that where you have an issue which is potentially quite contentious and you have a small number of people who are arguing very strongly for one position, but you think that that view is not likely to be shared across the wider membership, or is indeed likely to be opposed across the wider membership, then you actively shouldn't be acting on it. So government is right behind trustees in the idea of not succumbing or feeling like you need to give way to kind of noisy divestment movements where those are actually very small numbers of people in your schemes.
Thank you. Okay, so we
maybe
have
I can add like from a product perspective around impact. So definitely on the fixed income side, with a green bond index, that's the type of product that I think are available, for investors looking to have impact. Then I think we also back in 2015 started our SDG research, so really looking at different data points in order to measure impact and really alignment with the SDG. It's been quite a long journey because obviously it's not an easy task to really assess the alignment with the SDG, especially among large companies. And this actually model has went through different iterations, and we recently just improved the model and also disclosed a new way to assess alignment with the SDG, because we see a lot of interest from investors around that. That could then potentially feed into an index, but I think. Yes, there's more to come on the SDG side, and I'm sure we'll see, going forward, way more product on the market using the SDG data and SDG indices. Okay,
thank you, all of you. I'm getting messages to say it's time to wrap up now, so I better do so. So thank you all so much for joining us today. Many thanks to David, Vero, and Andrew for that terrific session today. Thanks again to all of you for watching and participating. We hope to see you all at a future PLSA webinar or online event soon. Thank you very much.
Thanks.
Thank you.
Bye-bye.